Hello everyone, this is Joey from PhilipNova. I will facilitate the webinar today. Thanks for everyone tuning in online on time. Let's give 3 more minutes for some registrants to tune in. The webinar will start at 7:03 p.m. sharp. Thank you. Okay, thanks everyone for joining the webinar. Today's webinar topic is Option Explained, Introduction to Options and Strategies for Today's Market. The webinar breaks down the fundamentals of the options trading, guiding you through key strategies like covered calls and protective puts, techniques used by the both conservative and active traders to optimize returns and hedge risks. Through real-life examples, you will gain practical insights into how options work, when to use them, and how they will fit into today's market conditions. Whether you are new to the options or seeking to refine your strategies, this session will equip you with the knowledge to trade options with confidence. Before we kickstart our session, just wanted to do a quick introduction of Philip Nova. We have been in the financial industry over 40 years, and maybe the name sounds a bit new to you, but we were rebranded from Philip Futures to Philip Nova in the last 2 years. Philip Nova was inaugurated in 1983 as a member of Philip Capital Group and is one of the founding clearing members of Singapore Exchange Derivatives Trading, SGXDT. We have since grown to become one of the region's top brokerages for the trading of stocks, CFDs, forex, global futures, commodities, and options. Today's topic is about options, and we actually have a promotion for you if you would like to start with the gold options first. From now till 30th of June, simply trade gold on Philip Nova 2.0 platform, and you will enjoy a Golden Village Gold Class cinema experience. You can scan the QR code on the right-hand side with more information. And also at the same time, if you wanted to know more about the promotions, because we are also having different kinds of promotions for different products, like stocks, ETFs as well. So you can scan the QR code on the left-hand side to learn more. And we also have different webinars and seminars with different topics tailored for different traders. So you can also scan the QR code on the right-hand side to register for more webinar and seminars. We also have both English and Chinese webinars for you to choose. And back to today's topic. Let me introduce our analyst Danish today for the speakers to kickstart the session. Danish is an investment analyst with Philip Nova. His areas of expertise are in equities, equity indices, forex, and commodities. He frequently shares his views and opinions through daily market commentaries that are sent to customers. Danish is also well-versed in technical analysis. His market views and commentaries are regularly published in the Business Times, 联合早报, and The Age Singapore. If you have any questions during this webinar to him, you can just text at the chat box. We will address them at the end of the session. Okay, now let me pass the time to Danish. Danish, your turn, please.
Okay, hi everyone. So before we begin, let me go ahead and just share the slides. Okay, so hopefully you guys can see. Do sound off if you guys are having issues with the audio or with the slides. So today's session I'll be mainly introducing options as well as some strategies, especially in today's market context. I won't delve too deep into some of the more complex option strategies like multiple legs, but mainly focus on strategies that are more suitable for like newer investors or retail investors who don't want to get too much or too deep into the complex world of options. So just a short disclaimer, this presentation is for educational and circulation purposes only, mainly because we do not take into account your specific investment goals, your financial situation, as well as your particular needs. So this is today's outline. I'll kick things off by introducing options. So just to summarize, there is actually a wide world of different option strategies. You can see from this table I provided. Typically, newer investors, it's advisable that we suggest them not to do too complex kind of strategies. So these are some of the more popular strategies that I'll be covering today. Mainly a protective put as well as a covered call. So let's talk about why. Why should you learn more about options? And I think something that I think is very useful, like the name options imply. Options actually give you a wide, a wide variety of different options to express your view on the markets. And you can see in this slide as well, there's a lot of different benefits. We'll come back to this slide at the end. For example, it allows you to manage your risk through strategies like protective puts or covered calls. It also provides you a lower cost way to long or short the market. There is a particular strategy called the zero cost collar, where you essentially have a long or short exposure at just a fraction of the cost. And also, quite uniquely, I think option strategies allow you to profit in any type of market condition. It can be up, down or sideways market, depending on your type of strategy. Income generation as well through strategies like covered calls. And lastly, as I've mentioned, your option strategy can be tailored and customized to fit your own specific market view. All of us have different views in the market. For example, if you're mildly bullish on the market, there are strategies like covered calls or callers to enhance your yield while gaining a little bit of upside in the market. So some basics of options. I'll probably go through this a little bit quicker, as I believe the audience, you guys are probably a bit familiar with options as well. So there's two main types. We have call options, which, as a call option buyer, when you buy the option, you essentially have the right, but at the same time, you're not obligated to buy the underlying asset. So it could be gold futures, it could be stock, it could be an ETF at a particular strike price within a specific period of time, at least until the expiry date. And on the other hand, the opposite, we have put options, which is essentially the same as a call option, but instead of having the right to buy the underlying asset, we gain the right to sell the underlying asset at the strike price. So there's two parties involved. Again, we have the call buyer, who has the right to buy the underlying asset at strike. But on the other hand, we also have the call seller, or we typically call them call writer. And compared to the call buyer, when you write options or when you sell or short options, you are typically obligated to actually deliver the underlying asset at the strike price. So it doesn't matter. For example, you are shorting or writing call options. You are obligated to deliver it at the exact strike price. It doesn't matter, how much you actually, what was the price that you initiated your position at. So it's an obligation, and it's different from the call buyer, who has a choice whether he wants to exercise or not. And again, we also see the same for put options, but on the other hand, for put writer, you're obligated to take delivery, because again, the buyer is selling the underlying to you. So you're obligated to take the underlying asset at the specific strike price. So there's some other terminologies as well. Expiration date. All options have a maturity or expiry date. However, if they are not exercised by the expiry date, the option themselves will be worthless. Also, we typically say that it will expire worthless, and you can just think of it as like a can of tunas. Once it hits its expiry date, typically people won't eat it and will just throw it away. And it's quite similar, so once options hit the expiry date, typically they have zero value. There's two different types of options, European options, American options. And the way to remember this is that for European options, they can only be exercised on the expiry date. So the first letter of European is E, and you can just simply compare it. E meaning exercise at expiry, and then for American options, the first letter is A, and so A is for exercise at any time. So quite simple so far, and just a few option basics as well. So what are the conditions for call buyers who exercise the options? So when you buy a call, typically your main market view is that you're bullish on the market, and people tend to exercise once the underlying price, for example, gold futures, once the price of gold rises above the strike price. So you can see that we typically exercise it when the current market price is above the strike price, and the opposite is true for put options. Typically, put option buyers are bearish on the particular underlying. So some terminologies as well. This is the futures and options products on our Nova platform, and something important to know as well is the option premium. It's essentially the current market price of an option contract. All the strike price that I mentioned, it's not the you don't buy an option or sell an option at the strike price. You buy or sell the option at the option premium. So you can see over here, the second row over here, the bid and ask price is the option premium. And this is very important because the premium is essentially the income that you receive if you write an option. And if you are an option buyer, when you buy the option, you have to pay this specific premium. So a key formula as well, the option premium, typically it's determined by the combination of intrinsic value and extrinsic value. So I don't want to get in too deep into details. Intrinsic value, there's a couple of formulas that I'll provide later on, and extrinsic value is typically determined by the time value of the option as well as the volatility of the option. So this is just rough formula as well to keep in mind. So if you guys need to, do feel free to take a photo of these slides as well. So typically, option traders and like analysts like myself, we tend to look at what we call an option chain. There's a lot of different ways to look at an option chain, but one of my favorite ways is to put the strike price in the middle. And then we have, for example, on the left, we have call options, and the bid and ask, which are the option premiums. And then we have puts, the bid and ask for puts, which are the option premiums as well. So something important to know moving forward and to really understand the rest of this seminar is that in the money options tend to be more expensive. And when I say in the money, essentially it means that the option is already able to be exercised, and when it's exercised, it's profitable. So for example, if you remember, for call options, we say that people tend to exercise it when the market price of gold is higher than the strike price. So we see over here, this is for the April 2025 gold futures contract. When at the time of this screenshot, the price of the gold contract was about 2955. And so for all the options strike prices over here, at least below 2955, all the options over here are in the money because they are, they're essentially profitable and you can exercise them at a profit already. However, we see that out the money options, basically, if they are not ripe for exercise, they haven't, the conditions for exercise haven't been fulfilled. We see that when you look at the bid and ask price, in terms of the option premiums that you pay and you receive, out the money options tend to be cheaper than in the money options. Why? Because in the money options are more valuable because they are already exercisable, while out the money options, they are not as valuable because there's no intrinsic value, meaning that it's not ripe for exercise yet, and there's only extrinsic value, which is made up of time value and volatility and all the other factors as well. So the first I would say position or strategy for an option, the most basic one would be to long a call. Typically you long a call when you're bullish on the market. So we have the payoff to the call buyer, and a very simple way to just remember or to just memorize this like a formula and how to calculate your payoff, right? So the idea of even buying and longing a call is that you will essentially be buying the underlying at the strike price. So just if you think about it, when you buy an underlying, essentially you're paying money. So that is why the X, which is the strike price, will have a negative sign because it's a cash outflow. And the key idea is that if you are able to buy the underlying at a lower strike price in the market, you are essentially able to buy it at a lower strike and then sell it at a market price that is higher. So this is essentially the payoff, and you'll make a profit as long as the market price, which is S, is higher than X. But something important to remember as well is that your payoff on your options, they do not equal to the profit that you receive, because as a call buyer, remember that we need to pay an option just to own, we need to pay the premium just to own the option. So the actual profit will be the payoff, and then you minus the call premium that you're paying. So this is the I would say the true formula to calculating your profit when you go long a call. And then the long a put, it's simply the opposite. You just have to flip the signs, payoff to a put buyer, you take the strike price, then you deduct by the market price. Again, for the full profit, we need to take into account the put premium that we're paying. As long as we are long options, we have to pay a premium to own the specific option. So what about the other side of the trade? What if we were to short or write a call? Again, when we short or write a call, we are taking the opposite market view. When you long a call, you are bullish, but when you short a call, I would say that you're bearish or you're neutral. But typically the main goal is to generate income. So let's talk more about that later on. So I won't dive too deep into the formula as well. You guys can simply take a photo and just refer to it later on. Very simple. The previous payoff I gave for a long call, you just have to add a negative sign in front. And the maximum profit, you can see from this thing over here, is limited to the premium that you receive. Because when you short a call, when you write a call, right, your main aim is that you don't want the options to be exercised. As long as it's not exercised, you'll continue to receive the premiums that the long party is buying. As you can see over here, this chart, the profit that call writer will receive, the maximum is $4, which is the premium. However, we tend not to recommend or advise clients to have a short call position, or this is what we call a naked call, because your maximum loss is theoretically unlimited. You can see this graph on the right hand side as well. The graph is essentially extends to infinity because your underlying price can theoretically go up to any amount. For example, if your underlying is gold futures, gold can theoretically go up by maybe from, let's say, 2,900 today, it could go up to like 5,000, and then your loss will accelerate. And this is a naked or uncovered call, and it's a very risky position. So it's advisable that, especially for newer option traders, that we do not, trade short call positions without, speaking with, an advisor or someone who is more experienced in the option market. So how do we exit a short call position? Very simply, firstly, we can wait for option to expire. If the option is out of the money, and this is the best case scenario when you're writing a call, because you can keep your premiums. But the worst case scenario, if the option is in the money, we have to do what we call assignment, where we essentially have to sell the underlying at the strike, and then if we don't have it, we have to buy it in the market at a higher price. Another way is to buy back the call option, and in this scenario, it's very possible to profit due to theta decay. It's something to do with Greeks, which I'll talk about later on as well. And of course, people who are familiar with futures trading, to exit a short call position, you can very simply roll your position to the next expiration date. Then the question you guys may be asking, right? I've heard a lot of people ask this: why would people even sell options in the first place? Given that there's like a unlimited risk. The truth of the matter is that a lot of research and studies have shown that option sellers actually have a higher win rate than buyers. You can see that data from the OIC, or Options Industry Council, shows that sellers have a win rate of 60% versus buyers at about 40%, at least over the past 15 years. And this is because, realistically, your everyday markets, the volatility, I would say, is pretty rare. Of course, you do have your rare asset classes like Bitcoin, crypto, and all this, but most asset classes, they tend to gyrate, they tend to move very mildly. True volatility or high volatility periods tend to be quite rare. So option sellers tend to have a higher win rate over time, mainly because their main goal is that they don't want the options to be exercised, and the best scenario for them is that the markets, for example, they only go up or down by 1%, 2%, or like at most 3%. The worst case scenario for option sellers is when the market are very volatile, and for example, gold futures jumps by 7%. But we don't see it quite often. It's quite a rare scenario, and this is why option sellers statistically have a higher win rate. So when do we go long option and when to short? Again, there's a lot of different ways. Typically, when volatility is low, again, you don't expect very large unexpected moves, so there's less chances that the option will be exercised. And this is the ideal scenario for you to short options. When volatility is low, it's best to short puts and short calls because your options won't be exercised and you can continue to receive premiums. Of course, on the other hand, volatility is high. It's better to take a long option position because it's more likely to be exercised. Talk about this later on. I'll refer to this slide back at the end. There are specific strategies where you simply trade on volatility. In periods of low or neutral volatility, there are certain strategies like straddles and strangles. But I'll talk about this at the end, towards the end of the presentation. So let's talk about the second section. I'll be talking more about covered calls. So covered calls, or the other name is called buy right strategy. It's essentially a naked call, or uncovered call. Remember that in a naked call strategy, you only collect premium. So your reward is limited to the premium that you receive. The maximum profit that you can make is the premium of, let's say, about $4 according to this chart, but your loss or your risk is unlimited. So from a purely like a technical or like risk reward perspective, I would say this isn't a very good prospect, because your risk is unlimited and your reward is limited. Therefore, a very popular strategy is what we call, I'll skip this because you can see over here, this is a naked call strategy. As long as the underlying price keeps increasing, we see that the losses in this option position will tend to accelerate to infinity. So as I was saying, one of the more popular option strategies is what we call covered call. The main goal is for yield enhancement, meaning you continue to gain income. And it's essentially your simultaneous purchase of the underlying, while again maintaining a short call option. So you short a call, and then you also at the same time own a long underlying position. And the main reason is that you are sort of pretty much covering or hedging your position by having the underlying asset. You can see the chart as well for this strategy is very different. Your risk at least is limited, because on the downside, your underlying can hit zero. The lowest you can go is zero, and your profit is the same, but you do have some participation in some upside. So some examples as well. Let's say we have a long COMEX gold futures position, and take note that the prices over here are purely theoretical in order to make things easy to understand. We have long this gold futures at about $20. This is our starting position. Then we short a call with a strike price of $30. So at the same time, because we short the call, we are receiving a premium of $1.50. This is a chart that I managed to extract for this strategy. So your main view is that you believe that gold will not top the $30 level, or which is essentially our strike price. In today's market, I think a very important level is the $3,000 level. Everyone's essentially watching that level. So again, you have a view. You believe that gold will not breach the $30 level in this scenario. But gold doesn't generate income. It's a non-interest yielding asset. So you do a short call in order to generate some premium, in the meantime. So you have a long goal, and then you short a call to generate premium, generate income. So as long as the gold prices trades below the $30 strike, you can see over here, as long as it trades below the $30 strike price, we can continue to collect the premium of $1.50 because the option will not be exercised. Again, for call options, people will exercise it as long as the market price of the underlying goes above the strike price. So as long as it's below $30, the option will not be exercised. And because you're shorting a call, you can continue to receive the premium of $1.50. However, once it trades above $30, your option will be exercised, and then you have to sell your underlying. So in a way, you sort of give up additional participation in any upside above $30. I think this graph is very, very useful. You see that the graph is essentially flat. Once we hit the strike price of about $30, the green line essentially is the profit and loss. The y-axis is profit and loss. X-axis is the price, market price and strike price. We see that once it hits $30, the P&L is flat, meaning that we do not, make any. The maximum profit we can make is $30. So if gold, for example, rallies to about $45, we do not, enjoy the full upside. So the best case scenario for covered call is when you are, moderately bullish, or your outlook is that gold prices will be very range bound. In this scenario, you believe that gold prices will probably still stay quite high, maybe ranging from about $20 to $30. The risk, of course, is that there is still it's still possible that you make losses, but the premium that you earn from your short call will somewhat help offset the decline. So the Goldilocks, or the best case scenario, like I mentioned, is in a moderately bullish market, when the gold prices are moderately moved to the upside. So there's other certain formulas to keep in mind. We have the break-even point, which is when your option strategy will start to make profit. The break-even point for a covered call is simply the underlying minus the premium. And the profit formula, which is very important, essentially is the change in your long underlying position minus your option payoff plus your call premium. So I don't want you guys to memorize the formula or anything, just have to understand what the specific strategies do, what are their benefits, and when is it applicable to apply such strategies. So again, just to go through the different scenarios, when the market is uptrend, let's say COMEX gold is above $30, we still make the same So in this scenario, your covered call strategy will underperform because your upside is capped. You do not sort of enjoy the full rally. For example, if COMEX gold rallies to $45, because your profit is limited to this about $13 to $14. So the best case scenario is when the market is range bound. For example, when it's between $20 to $30, and it'll outperform because you can get to keep the premium, while at the same time enjoy the upside, of gold prices when it rallies from 20 to 30. So this is the best case scenario. And even when it's a downtrend, you can still profit as long as the decrease in the underlying is smaller than the premium that you receive. So you can see there's this very small little area over here where the premiums you receive are still able to offset the decline in your underlying. So another example, let's refresh and solidify our understanding of covered calls. This second example, let's say you have a long S&P 500 E-mini futures, but your view that you think that its price will be unable to break the resistance at about $6,000. So because you believe you'll stay, range bound below 6,000, and you want to receive income, you short or you sell out the money call options and you receive the premium. So again, in this scenario, we go long the S&P futures at the underlying price of about 5,700, and then we short a call option. The strikes at $6,000, and we receive a premium of $28. So again, keeping all this in mind, and this is the chart that I was able to generate. And those two key formulas as well, which I mentioned. The break even is the purchase price, which will be 5,700, and then you minus the premium that you receive. And the profit will be this formula, which is given over here as well. So again, in the first scenario, let's say S&P 500 rises to 5,900. The blue line is the current spot price. Let's say it rises to 5,900. You can see that it starts to make a little bit of profit at about $228. And the second scenario, if it rises to above, the strike price of $6,000, maybe somewhere around here, we see that profit is $328. And, it doesn't matter, how much it rises. It could rise to even 7,000. The profit will still be $328. On the other hand, let's say it falls to 5,200, we make a loss, but this loss is slightly reduced by your premiums. And let's say you didn't have this short call position, and you have a pure long position. Your loss will be about $700 because your S&P drops from 5,700 to 5,200. Oh, sorry, your loss will be $500. So you're slightly able to somewhat offset your loss because thanks to the premiums. So this is a summary of the covered call option strategy. Again, the view is that you apply this strategy when you're moderately bullish on the market or your view is a range bound market. How do you construct it? You have a long underlying and then you sell and out the money call. These are the two key formulas as well. Break even is when you start making the price point where your strategy will start making a profit. This is the profit of your profit formula for your covered call position, and these are the different advantages. Generate income. Your reward is that you earn premiums, but it's important to take note as well that the risk of a covered call is not unlimited. There is still risk, but it's somewhat offset by your premiums. So these are the different scenarios as well. In an uptrend market, your covered call will underperform. Best case scenario, the market is flat or choppy, it will outperform. And you can also, say that in a downtrend market, your losses are limited. So you are technically outperforming, investors who are purely long the market. And it's something important to take note as well. When markets are very volatile, especially for options, as option traders, typically there's a saying that volatility is our friend, because when markets are volatile, the premiums generated or the premiums on the market is higher. So, sometimes when the market is more volatile, you're able to essentially, as a short call or call seller, you are essentially able to earn higher premiums. So some things to keep in mind as well before you trade. I think some investors, especially those who are newer to options, they sometimes are a bit confused because of the different expiry dates. Especially for options, there's a few different expiry for contract months. It could be a weekly expiry, it could be monthly expiry. So there's a lot of things to take in mind. One thing to note for options, right, is that there is a concept which we call time decay. Recall that I mentioned that the premium of an option is given by this formula, intrinsic value, which is the payoff. Remember the formulas I gave, the S minus X, right? This is what determines intrinsic value. Then you have extrinsic value for the option premium, which is determined by a variety of factors, but the biggest factors are time decay and volatility. So time decay is a concept where the option premium or the option price, it will essentially decline the closer an option gets to expiry. And it's very similar to a tuna can. When you just buy a can of tuna, I would say it's at its maximum value because it's still very, very far away from expiry. But the closer the can of tuna gets to its expiry date, it sort of becomes less valuable because it's more likely that it will essentially expire and then become a worthless can of tuna. So again, if our goal is to maximize income, essentially the amount of premiums that we collect, the best possible option will be to choose options with a short expiry. Why? Because even though the premiums will be lower, like I mentioned, but we will be essentially able to write calls more frequently. For example, if the expiry is short, we can, for example, write like maybe 4 calls in a month. So our total premium income per year will be higher compared to if we were to, write a call option for an option with a longer expiry. But again, this is under the assumption that the market is favorable for us. If the market is unfavorable, a better option will be to write a longer dated call, collect higher premiums in the beginning, and all these higher premiums will help us to offset any losses in an unfavorable market. So to make things simpler, shorter expiration options will it will make our total premiums collected higher, provided if the market is favorable. However, longer expiration options, they are more conservative and they somewhat provide a greater margin of safety. So again, the concept of time decay or theta decay is very important. The time decay or the decay in your option value will increase the closer an option is to expiration. Therefore, a longer dated option is sort of more forgiving for investors because there's a longer time frame where the underlying price, for example, gold, will move in a favorable direction. And typically for option beginners, it's recommended that any options trades that they make are on option contracts with at least 1 month to expiry, because shorter dated options are more volatile due to time decay. So another subject which is sometimes confuses investor is the subject of option Greeks. It tends to be one of the more complex concept when it comes to options, but I must say that for Greeks there is less of an importance on Greeks if your main goal is to simply use it as a complement to your underlying position, or that you just want to hold up your options to expiry. It's more important for traders who are, I would say, actively trading options, meaning that they buy an option and then they hope to sell the option at a higher price. And when I say price, it's referring to the bid or ask, essentially the option premium. So there's a few famous Greeks. I will address the most basic option Greeks. We have the delta, which essentially is how much the option premium or the option price will change for a $1 move in the underlying. For those of you who are familiar with trading stocks, it's somewhat similar to the beta ratio. Essentially, if the underlying moves by, let's say, $1, if your delta is 0.5, your option price will change by 50 cents. And important to note is that calls have a positive delta while puts have a negative delta. And again, the closer your delta is to 1, the closer you are to essentially having a long underlying position. So for example, let's say your call option has a pure perfect delta ratio of 1.0. It's essentially no different from essentially just trading the stock itself or the underlying itself. So there's two different key takeaways here. If you want quick price movements, you want to essentially see the most amount of profits, high delta options are your choice because they are more sensitive to the underlying price. If you want lower risk, lower delta options are a safer choice. Typically we tend to prefer delta with maybe about 0.6, 0.7, or if you are safer, maybe 0.3 to 0.4, 0.2. And again, we have theta or time decay, essentially how much value the option loses per day as they approach expiry. Options with higher theta, essentially they lose more. Their option price will decline more as they approach expiry. So again, lastly, we have Vega, which essentially measures how much your option premium will change for a 1% change in implied volatility. Implied volatility, I don't want to go too deep as well. It's essentially forward-looking volatility, how much the market expects volatility of a specific asset will be in the future. So the important thing is that the higher the implied volatility, the higher the option prices. And this is especially when you're actively trading, because with the IV, or if the IV is very high, the options are more expensive, and you may essentially overpay for an option. So to very simply summarize a delta, you understand how much your option will move with the underlying. Theta helps you manage your time decay. You preferably don't want an option with too high of theta. Theta shouldn't be too high. And Vega is, I would say, it's a Greek that's more useful for active option traders. Essentially, they use it to assess whether the options are overpriced or underpriced. So now let's talk about protective puts. I would say this is probably the most popular option strategy because it's very easy to execute, and a lot of us have long underlying positions. It could be futures, it could be stocks, it could be ETFs, and it's the easiest strategy to execute as well because we simply have to just initiate a long put position, and that's all we do. So it's again protective puts. Another name for it is merit puts. So how do you execute this strategy? Like I mentioned, it's just a long position in an asset, and you add a long put position. The graph is over here. The green line again is the profit and loss. You can see as well, just off this chart itself, you can see that your loss is limited at once it passes a certain price. Once the underlying price goes below a certain point, you are essentially able to limit your loss. But at the same time, your potential profit is unlimited. So let's talk more about this strategy. Typically, we use a protective put strategy to hedge downside risk, but at the same time, we still maintain some exposure to the upside. What do I mean by that? For example, when you go long a put, remember that we still have to pay a premium, but we don't have to exercise it. We don't have to exercise it. It's still a choice. So if the market moves very favorably, essentially we don't have to do anything with the put position. We can just enjoy the upside of the underlying price. But I would have to say that the upside of a protective put position is actually lower than a non-protective put position, because remember that you are paying extra premiums for essentially more protection. So let's again use COMEX Gold futures as the underlying. Let's say we long COMEX Gold futures. We initiate it at about $50, and then we long an in-the-money put with a strike price of $45. The put premium that we are paying is about $2. So again, this is the profit formula. I don't want you guys to memorize it. It's probably a bit too draining for your minds as well. So there's a few different scenarios when the market is an uptrend. Looking at this chart as well, we can see the upside is unlimited. This chart essentially stretches out to infinity, but because you're paying premium, it will reduce your total return. But it's not all useless. You're not paying premium for nothing. It's essentially you're paying extra premium for insurance that in the event the market moves unfavorably, your losses will be limited. So let's look at this case study over here. Let's say COMEX Gold increases from $50, which is the blue line over here, $50 to $70. We can see that a pure long position, very simply, you will have a $20 profit in gold, but with a protective put position, your overall profit will be $17 because you're paying extra premiums. However, on the other hand, let's say the market is in a downtrend, you will outperform the market because you are essentially limiting your losses. And let's say gold drops to $30 from $50. So from the blue vertical line over here until this area over here, when the underlying reaches $30, we can see that a pure long position would mean that you have made a loss of about $20. But because you have a long put position to protect your underlying, your loss is essentially limited to just $7. So you can see the difference in strategies as well. The application between protective put and covered call is pretty, I would say, quite different as well. So again, the overall theme of a protective put is that you are able to gain downside protection, while at the same time you have some participation in in capital appreciation or the upside of the underlying, but your overall upside is reduced because of the premiums that you are paying. So let's give a summary of the different option strategies so far. This is the first one that I addressed. It's a short call or naked call position. Again, most of the time when you short a call, your view is that you're bearish. You don't want the call option to be exercised. However, the risk is that your risk or your potential loss is unlimited because the underlying price theoretically can go up to infinity. You can see that on the x-axis, this is the underlying price. Let's say it goes to 9,000, your losses will continue to accelerate and accelerate as the further the underlying price increases. On the other hand, your reward is simply just limited to just the premium you receive. So you can see it's not a very favorable risk-reward ratio. And this is why most often people will use what we call a covered call strategy, where most of the time our outlook is that the markets will be flat or just moderately bullish. For example, in the scenario I mentioned, you don't believe that gold prices will breach 3,000, but you believe that they could see some mild upside, maybe test about 3,000, maybe about 2,950, and then maybe drop back down. So some, mild upside, but not too much. This is the best case scenario because the short call or your call position won't be exercised, and you can continue to receive premiums while enjoying participation. Of course, there is still risk, but it's limited because the underlying has a theoretical limit of 0. And again, your risk is also slightly offset by the premiums that you're receiving. So some other interesting strategies as well. Like I mentioned, we have the protective puts. Again, it's more of like a insurance strategy, protect against losses. Let's say you have a long position in like soybean futures, gold futures. You don't want to close your position, and you're willing to accept a lower upside. And the main point is that you want to protect against losses, and you can very simply construct this strategy by having a long underlying position and a long put position. Your risk is limited, as you can see over here. Your reward is potentially unlimited, but it's still lower than a pure long position because of the premiums that you're paying. So some other option strategies which I didn't address, I don't want to delve too deep into them. I did make some mention of a collar strategy. It's essentially a mixture of a protective put and a covered call. You have a long underlying position, and then you long a put, and then you short a call. So the main view of this is then again is that you're mildly bullish, but you want to protect your profits And in a very rare case, in the scenario where your long put, the premiums that you're paying or your long put position is able to uh, somewhat offset by the premiums that you receive on your short call position, you are able to achieve what we usually call a zero cost collar. Basically, it's zero cost to initiate a collar position, but in reality, it's not really zero cost. I would say it's like low cost collar. So, the main point of this strategy is that your reward is limited, your risk is limited, and the main, view or main expectation is that you want to protect your profits that you've already made. So I think some interesting strategies as well, perhaps a bit more advanced. We have what we call market neutral or non-directional strategies. Remember that I mentioned that as an option trader, you don't have to simply trade, on direction. You can actually trade based on volatility, where it doesn't matter which direction your price move up or down. You're essentially trading on how much the underlying moves, whether the price movement is very big or whether the price movement is very small. So we have what we call a straddle strategy. How do you construct this strategy? You long an at the money call as well as a long at the money put. And when we say at the money, essentially the strike price is the same as the underlying price. So the underlying strike price expiration is all the same for both options. And for a straddle strategy, we are expecting significant volatility in the near term. And if you take a look at this graph, I think it's pretty obvious what the goal is. Essentially, we profit whenever there's extreme price movements at either end. Let's say, we have gold futures. Let's say the current market price is about 2,950. If gold futures drops to about 2,500, if with a straddle strategy, we are still able to make a profit. While on the other hand, let's say it rallies all the way to 3,300 or 3,400, we are also still able to make a profit. The risk of this position is that maximum loss when the underlying, trades at doesn't change. Essentially, it remains at the strike price. But another downside, which I think I missed over here, is that this strategy is quite expensive. So your profit may be somewhat offset by the total premiums that you're paying. Because recall that at the money options are more expensive. In the money and at the money options are more expensive than out the money because they are essentially more exercisable. There's a higher chance that the options will be exercised. So again, the main reward here is that you'll make a profit regardless of the underlying price direction. You'll profit as long as the price movement is big enough towards either direction. So on the other hand, we have a strangle strategy. The view is roughly the same. The application is the same as well. But what's different is the construction over here. Instead of longing an at the money call and at the money put, we long a higher strike out the money call, and then we long a lower strike out the money put option. And because it's out the money, it's cheaper than straddles, like I mentioned over here, because out the money options are cheaper than in the money options. So again, the strategy, the application is the same. You're expecting volatility in the near term. However, you see that the maximum loss is actually at a range rather than a single price point. Your maximum loss you'll see is when the underlying trades between the higher strike price of the call and the lower strike price of the put, which is over here. So both scenarios, we are essentially not trading on direction, we're trading on volatility of the market. So remember this slide I showed earlier. Again, over here, so it's a undecided or I would say a neutral market strategy. You may not have a specific view on the direction of the markets, but what you're certain will happen, or what your view is that for let's say the next month or so, the market will definitely be very volatile. So you go long a straddle, long a strangle. On the other hand, let's say you think volatility is very low, you simply do the opposite. You just short a straddle or you short a strangle. And a short straddle or strangle essentially is the opposite. Your graph will essentially be flipped upside down. So again, in periods of low neutral volatility, markets will move within a tight range. So short straddles and so as different strategies like condor and butterflies will be more profitable in these environments. So diving back to our main point, the first few slides, why should we use options? They provide essentially more flexible and complex strategies like the straddle and strangle strategies I mentioned that essentially allows you to profit under any market scenario. You don't really have to have a directional view. We also have the protective puts and covered calls who essentially allows you to profit in different market conditions as well. It's a lower cost way to go long or short the market. Again, if you have a protective put, you can use it as a hedging device. Again, we can also trade on volatility. Like I mentioned, straddle and strangles. If you're buying a call or put, your loss is limited to the premiums you paid. Because again, at the end of the day, it's up to you. It's a choice whether you exercise it or not. So just one final slide before I end this presentation. One favorite indicator I like to use, mostly in the markets, and I would say almost every day that I look in most asset classes, is what we call the put-call ratio. So this chart over here, I think I took it towards the end of February. This is for the gold contract. I think it's the April 2025 contract. And this was actually when the gold prices was close to breaching 3,000. It was around 2,962 for gold futures. And a very good ratio or interesting ratio that I look at is the put call open interest ratio. And for those of you who are unfamiliar with the term open interest, essentially it's the number of outstanding option contracts that are open, essentially people who are trading it but it's not yet closed, contracts which are not yet closed, liquidated or exercised. So essentially with this put call ratio, if it's higher, this means that the number of or the open interest in puts, the number of open positions in puts is higher than the number of open positions in calls. And I think this is a good sentiment indicator because essentially you're just looking at how the options market is viewing a particular asset. More puts basically means they're more bearish, more calls means sentiment is more bullish. And I think it's a pretty reliable indicator as well. A couple of weeks ago, gold was at 2962, and at this time, the put call ratio, you can see the trend is very obvious. It's on the uptrend, so it's quite a bearish indicator as well. And I think after this, we actually saw gold prices start to dip slightly lower. So I would say this is quite a good ratio. It's something that I believe will be useful for any of you guys who are interested in trading options. So I think that will end today's presentation. For those of you who are interested, you can talk to me. This is my email and this is the office number. Do feel free to contact my colleagues at the client relations and sales channel department as well. So now I think we'll proceed to the Q&A session. I'll let Joey take control of the proceedings.
Hello, Danish. I think thanks for your comprehensive explanation of how options are. I think there's attendees asking what is the commission cost for the trading options. I think you can go to the www.philipnova.com.sg to learn more about the commission cost, or our salespeople can reach out to you to explain a little bit more on how options work and also our fees and charges for trading options. So stay tuned for our salespeople to reach out to you as well. And then at the same time, you can just reach out to go to our websites to learn more. Danish, I wanted to ask you a question from the audience as well. Can you have maybe 2 to 3 key takeaways for today's session?
Okay, let's give a few takeaways. Let me go back to my slides. I think the main takeaway from here is that options provide you a lot of more flexible and different strategies for you to play the market. We have covered calls, which is used when you have a mildly or more moderately bullish view on the market. We have protective puts when you want to essentially have insurance on your underlying positions. And we also have a very unique strategies where you don't have a directional view, but you believe that volatility will be very high or volatility will be very low. We have strategies like straddles and strangles, and other than that as well, I think the key point about options that I would like people to take away here is that it's not, I would say, for may sound very complex, it may sound very daunting, but some of the strategies I introduced today, for example, protective puts, covered calls, in reality, they're not very hard to execute. Most of us already have an underlying position. For example, we may own a long underlying position in gold futures, but maybe, we just want some insurance that if gold prices suddenly collapse, we are sort of, somewhat able to protect our losses. So I would say that options come very useful in this scenario. Like their name suggests, they provide you with more options for you to protect or increase your profits. And like the scenario I mentioned, if you want more insurance for your gold positions, you very simply just have to go long a put option at, let's say, a particular strike price. Gold, maybe it could be at a strike price of 3,000, at a strike price that you don't believe gold will breach. For example, for puts will be different, but the main idea is the same. Essentially, options will give you more options to enhance your portfolio or your investments. Yeah, I hope that addresses the question.
Okay, thank you, Danish. I think there is one more question is saying about how does like news and also like earnings announcement and also some of the microeconomic events affect option pricing?
So I think it was in one of my slides, but one very important thing about the news earnings release and even the latest Trump tariff announcement as well is that what typically happens is that, let's say, nearing the earnings date, it's usually markets expect high volatility around the earnings date. And if you recall the concept I mentioned of implied volatility, as long as markets expect more volatility, for example, Nvidia's earnings, the entire market essentially is expecting that Nvidia prices will move up or down, doesn't matter. Price movements will be very large. As long as the price movements are large, option pricing or the option premium will be higher, because as an option seller, let's say you're selling options, volatility in this case isn't really friendly to you, because large price movements increase your chances of the options being exercised against you. That's why option sellers demand higher premiums just for selling the options. So to answer your question very simply, option pricing or option premiums, they'll increase around high volatility events. I hope that answers your question as well.
Okay, thank you, Danish. I think let's have one more question, the final one, just to wrap up today's session. I think there is one audience saying about, will stocks ex-dividend or actual dividend payout date affect the option price as well?
Well, that's quite a question. I haven't really heard that before. But if I'm not wrong, certain stocks or counters nearing the ex-dividend date, the prices will drop. But I don't think it has much of an impact on the option pricing, mainly because option pricing, they are not a main driver is volatility, not really ex-dividend. Typically, what drives it more, at least from my personal observation, will be earnings release, economic events. For example, the latest drivers will be tariff announcements, tariff deadlines from Trump. Yep, I hope that answers the question again.
Okay, thank you, Danish. I think there are some audiences are asking about like some PCR for the individual stocks, and then what is the websites to look out for this. I think our salespeople will reach out to you to contact you again for this kind of questions. And then thank you again, Danish. And then let me just do a final introduction of what our company is offering before we end the session. Okay, I think if because Danish talks a lot on the options already, so if you are interested to go for gold options first, you can actually trade the gold options here, because what you can get is a Golden Village Gold Class Cinema experience. You can scan the QR code on the right hand side to learn more. And also, if you are interested to have more like promotions, because we are also offering different kinds of promotion for different kinds of products, for example, like stocks and ETFs, and also like some micro futures and also Nikkei, you can actually on the left-hand side to scan the QR code and then to learn more about the details of the full offerings that we're having. And then on the right-hand side, right, I noticed that there are some audiences that are asking about the Mandarin courses or like the Mandarin webinars. So for more webinars and seminars, right, you can scan the QR code on the right-hand side. We're also offering the Chinese webinars, so you can sign up and then to learn more as well. And then thank you guys for today's session, and then we hope to see you around for the next webinar and seminar. Thank you, Danish, as well. Have a good night. Bye-bye.